Most seniors haven't heard about this new 2026 IRS rule, and that could turn out to be a very expensive mistake. Right now, there's a major change quietly coming that could put thousands of dollars back into the pockets of retirees, and almost no one is talking about it. This isn't a small adjustment or a routine yearly update. It's a brand new opportunity written directly into the tax code that could dramatically lower how much you owe to the IRS over the next several years. And here's what makes this so important. If you're 65 or older, you could be eligible for an additional deduction worth up to $6,000 as an individual or as much as $12,000 for married couples. That's real money that could stay in your bank account instead of going to the government. But there's a catch. This rule is temporary. It has income limits and it only applies for a short window of time. Miss it and the opportunity is gone. Over the next few minutes, I'm going to break this down step by step in plain, simple language so you know exactly what this rule is, how it works, and whether you can take advantage of it. Because if you qualify and don't claim it, you could literally be leaving thousands of dollars on the table without even realizing it. It was designed specifically to give older Americans extra financial breathing room at a time when living costs keep going up and fixed incomes are being stretched thinner and thinner. So, in this video, I'm going to walk you through exactly what this new IRS rule is, where it came from, how much it could save you, and most importantly, what you need to do to actually claim it. By the time we're finished, you'll know whether this benefit applies to your situation and how to make sure you don't miss out on it. And trust me, you don't need to be a tax expert to understand this. I'm going to keep everything simple, straightforward, and focused on what really matters to you as a senior trying to protect your hard-earned money. So let's start with the big picture. What exactly changed and why is this such a big deal for seniors? The IRS introduced a completely new additional tax deduction aimed specifically at people who are 65 and older. It's being called the senior bonus deduction, and it's unlike almost anything we've seen before. Normally, when a new tax benefit comes along, it replaces something else or forces you to choose between options. But this one doesn't work that way. This deduction stacks on top of everything you're already entitled to. That means you keep your regular standard deduction, you keep the extra deduction you already get for being over 65, and now you add this brand new amount on top of both of those. Think of it like building blocks. Every layer gets added on top of the last one, creating a much bigger total shield against taxes. And that stacking effect is what makes this rule so powerful. It was created as part of a broader effort to give financial relief to older Americans who are dealing with rising medical costs, higher living expenses, and the challenges of making retirement savings last longer than ever before. The government recognized that many seniors are being squeezed financially. And this deduction was designed to help ease that burden in a very direct way. Instead of sending more of your income to the IRS, this rule allows you to legally keep more of what you've already earned. And the best part is, this isn't some complicated loophole or risky strategy. It's a straightforward, legitimate deduction written right into the tax code. But here's the important thing to understand. Even though this rule exists, it doesn't help you at all if you don't know about it or if you don't claim it correctly. That's why so many seniors could miss out. They simply don't realize this opportunity is sitting there waiting for them. And in just a moment, I'm going to show you exactly how much this could mean for you in real dollars and cents. Now, let's get into the part everyone really wants to know. How much money are we actually talking about? What does this new deduction look like in the real world for real retirees? Let's start with single filers who are 65 or older. Under the current projections for the 2025 tax year, the regular standard deduction for a single person is expected to be around $1,550. On top of that, seniors already receive an additional age-based deduction of about $2,000 just for being over 65. But now, with this new rule, you get to add another $6,000 on top of all of that. When you put those numbers together, the total potential deduction jumps to roughly $2,350. Just stop and think about that for a second. That means nearly $24,000 of your income could be completely protected from federal taxes before you owe even a single penny. For millions of retirees living on Social Security, pensions, or modest retirement withdrawals, that kind of protection can make an enormous difference, and it gets even better for married couples. If both spouses are 65 or older and filing jointly, the numbers become even more impressive. The standard deduction for a married couple filing together is projected to be about $29,200. Then each spouse gets their own additional senior deduction, adding roughly another $3,200 combined. And now, on top of all of that, comes the brand new senior bonus deduction of $12,000, which is $6,000 for each spouse. When you add everything together, a married couple could potentially shield around $44,400 of income from federal taxes. That is an enormous amount of money to protect, especially for households trying to make retirement savings stretch as far as possible. And here's what makes this even more remarkable. You don't have to jump through complicated hoops to qualify. You don't need special investments or fancy tax strategies. This is a benefit available to ordinary seniors simply because of their age. For many people, it could mean the difference between owing taxes and paying nothing at all. And that's why understanding this rule is so important. These aren't small, trivial savings we're talking about. These are potentially life-changing amounts of money for retirees on fixed incomes. In a moment, I'm going to explain another unique feature of this deduction that makes it even more valuable and flexible than most tax benefits out there. One of the most unusual and powerful parts of this new rule is how incredibly flexible it is. Most tax benefits force you to make a choice. You either take the standard deduction or you itemize your deductions. It's usually one path or the other, but this senior bonus deduction breaks that normal pattern. It works no matter which option you choose. If you're someone who likes to keep things simple and just take the standard deduction every year, you can still claim this new benefit on top of that. And if you're someone who carefully tracks medical expenses, charitable donations, and other itemized deductions, you can claim it as well. There's no penalty for choosing one method over the other. That makes this deduction far more accessible than most tax breaks seniors have seen in the past. You don't need a complicated financial situation to benefit from it. You don't need to own a home, have a mortgage, or keep detailed records of every expense. As long as you meet the age requirement and fall within the income limits, this deduction is available to you. And that's a big reason why it has the potential to help so many retirees. It was designed to be straightforward and easy to use, not just another confusing loophole buried deep in the tax code. But even with all of that flexibility, there are still some important rules and limitations you absolutely need to understand. This isn't a permanent change, and it isn't something you can claim forever. In fact, one of the most critical aspects of this entire program is the time limit attached to it. And that brings us to a very important point that every senior needs to pay close attention to. This deduction comes with a built-in expiration date, and that detail alone should get your attention. The senior bonus deduction is not a permanent part of the tax code. It's a temporary benefit that only applies for a limited period of time. As the law is written right now, this deduction is only available for 4 specific tax years: 2025, 2026, 2027, and 2028. After that, unless Congress decides to extend it, the entire benefit disappears. That means you have a 4-year window to take advantage of this opportunity, and then it's gone. Think about that for a moment. Many tax benefits last for decades or become permanent fixtures, but this one has a very clear and very firm deadline. If you don't use it while it's available, there is no going back later to claim it. That's why planning ahead is so important. Decisions you make about retirement withdrawals, part-time work, or other income over the next few years could directly affect how much you benefit from this rule. And that time limit isn't the only restriction you need to be aware of. This deduction was created mainly to help low and middle income seniors, which means there are income thresholds that determine who gets the full benefit and who doesn't. In other words, not everyone will qualify for the entire $6,000 or $12,000. The amount you can claim depends heavily on how much money you earn each year. If your income is too high, the deduction starts to shrink and eventually disappears altogether. Understanding those income limits is absolutely essential if you want to make the most of this opportunity. In the next part, I'm going to walk you through exactly what those limits are, how the phase out works, and how to figure out where you fall within the rules so you don't get caught off guard. So let's talk about those income limits, because this is where things get a little more technical, and it's also where a lot of confusion tends to happen. The government set up this deduction with what's called a phase-out system. That simply means the benefit gradually gets smaller as your income goes up. It doesn't disappear all at once. Instead, it slowly reduces until it eventually reaches zero at higher income levels. For single filers, the full senior bonus deduction is available as long as your income is $75,000 or less. Once your income goes above that amount, the deduction begins to shrink, and by the time a single filer reaches $175,000 in income, the deduction is completely gone. For married couples filing jointly, the numbers are higher. The full deduction is available up to $150,000 of income. After that point, the benefit starts to phase out and it disappears entirely once joint income hits $250,000. These thresholds are extremely important because they determine whether you get the full benefit, a partial benefit, or no benefit at all. But here's something encouraging. Even if your income falls into that phase-out range, it doesn't mean you get nothing. You could still qualify for at least part of the deduction, and even a reduced amount can still translate into meaningful tax savings. The key is understanding exactly how that reduction works so you can estimate what you might be eligible for. A lot of seniors hear about income limits and automatically assume they won't qualify. But in many cases, that simply isn't true. That's why it's so important to look at your own numbers instead of guessing. The actual phase-out formula is fairly simple once you see how it works. For every $1,000 of income you earn above the threshold, your bonus deduction gets reduced by $60. So let's say you're a single filer and your income is $85,000, which is $10,000 over the $75,000 limit. In that case, your deduction would be reduced by $600, leaving you with a $400 bonus deduction instead of the full $6,000. The same idea applies to married couples. If a couple's income is, for example, $170,000, which is $20,000 above their starting threshold, their $12,000 deduction would be reduced by $200. That would still leave them with $800 in extra deductions. The point is, even if you don't qualify for the maximum amount, you could still be entitled to a significant tax break. And every dollar of deduction you can claim is a dollar that helps lower your tax bill. This is especially important for seniors who might be right on the edge of those income limits. Small changes in how and when you take retirement withdrawals could make a big difference in how much of this deduction you're able to keep. That's why planning ahead for the next few tax years could be extremely valuable. But understanding the rules is only half the battle. Knowing how to actually claim this deduction when tax season arrives is just as important. And that's exactly what we're going to cover next, because the process is straightforward, but it does require a few specific steps. Now, let's get into the practical side of things. Understanding the rule is important, but none of it matters if you don't know how to actually claim the deduction when the time comes. The good news is the process is not nearly as complicated as many people fear. You don't need to hire an expensive tax professional just to take advantage of this benefit, and you don't need any special qualifications beyond meeting the age and income requirements, but you do have to take action. This deduction is not automatic. The IRS isn't going to apply it for you just because you turned 65. You have to actively claim it when you file your taxes. The first step is making sure you're using the correct tax form. Seniors will generally want to use Form 1040 SR, which is a version of the regular tax return designed specifically for older taxpayers. It has larger print and clearer instructions, making it easier to read and understand. On that form, there is a simple checkbox that indicates you are 65 or older. Checking that box is critical because it signals to the IRS that you qualify for age-related deductions. Then, in order to claim this new senior bonus deduction, you'll need to complete an additional form called Schedule 1A. That is where the actual calculation takes place. The form walks you through determining how much of the bonus deduction you're eligible for based on your income and filing status. Most modern tax software programs will handle all of this automatically as long as you enter your information correctly. But if you file on paper or prepare your own return, it's important to know exactly which forms to use and where to report the deduction. The main thing to remember is that this benefit only helps you if you take the time to claim it properly. Before we go any further, there's a very important myth floating around that needs to be addressed right now. A lot of seniors have heard rumors that this new deduction completely eliminates taxes on Social Security benefits. Unfortunately, that is simply not true. I want to be very clear about this, so no one gets the wrong idea. The senior bonus deduction does not directly make your Social Security income tax-free. The rules that determine whether your Social Security benefits are taxable have not changed. Those rules are still based on your total combined income. Just like before, what this deduction does is lower your overall taxable income. And by lowering your taxable income, it might indirectly reduce how much of your Social Security ends up being taxed. For some retirees, especially those with modest incomes, the combination of the standard deduction, the existing senior deduction, and this new bonus deduction could result in owing little to no federal income tax at all. But that depends entirely on your individual situation. This deduction is not a magic switch that suddenly makes all retirement income tax-free. It's a powerful tool, but it still works within the existing tax system. Understanding that distinction is extremely important because making financial decisions based on bad information can lead to unpleasant surprises later on. The goal here is to use this new rule wisely and realistically, not to assume it will wipe out every tax obligation you have. And when used correctly, it can still provide tremendous relief, even if it doesn't completely eliminate taxes for everyone. Let's take a moment to talk about what this deduction really means in practical, everyday terms. Tax rules and deductions can sometimes feel abstract, but at the end of the day, this all comes down to real money in your pocket. Imagine a single senior who qualifies for the full $6,000 bonus deduction. If that person happens to be in the 22% federal tax bracket, that deduction alone could reduce their tax bill by about $1,320. That's not just a number on a form. That's over $1,000 that can be used for groceries, medications, utility bills, or any of the other expenses that seem to keep getting higher every year. For married couples, the impact can be even larger. A $12,000 deduction at the same tax rate could save more than $2,600 in federal taxes. For many retirees living on fixed incomes, savings like that can make a noticeable difference in their quality of life. It could mean the ability to afford better health care, take a small vacation, or simply worry a little less about monthly bills. And remember, this deduction is available even if you're still working part-time in retirement. Many seniors pick up a few hours here and there to supplement their income, and this rule can help reduce the tax impact of those extra earnings. The important thing to understand is that this benefit was created to provide genuine financial relief, not just to shuffle numbers around on a tax return. When used properly, it can help stretch retirement dollars further at a time when every penny counts. If you found all of this information helpful so far, I'd like to take just a quick moment to ask for a small favor. If you appreciate getting clear, straightforward explanations about important financial changes that affect seniors, consider giving this video a like so more people can find it. It really does help get accurate information in front of others who might need it. Now, getting back to the details, let's summarize the most important points you need to remember about this new rule. First, you must be at least 65 years old to qualify. Second, the deduction is available whether you're fully retired or still earning some income on the side. Third, you can claim it whether you take the standard deduction or choose to itemize your expenses. Fourth, there are income limits that determine whether you receive the full benefit or a reduced amount. And fifth, and this is absolutely critical, this deduction is temporary. It only applies for tax years 2025 through 2028 unless the law gets extended in the future. Those 5 points form the foundation of everything we've talked about today. If you keep them in mind, you'll already be ahead of most people when it comes to understanding how this rule works. But there's one more very important topic we need to cover before we finish, and that's how to protect yourself from misinformation and potential scams related to this new benefit. Anytime a new tax benefit like this gets announced, you can be almost certain that confusion and misinformation will start spreading almost immediately. Unfortunately, that also means scammers and dishonest companies will try to take advantage of seniors who are simply looking for help. I want to give you a very important warning about that. You do not need to pay anyone special fees to claim this deduction. There is no secret program, no exclusive service, and no special insider method required. All of the information about this benefit is freely available directly from the IRS, and the forms needed to claim it are completely free as well. If someone contacts you claiming they can help you get this deduction faster, easier, or in some special way that only they know about, be very cautious. The truth is, any legitimate tax preparer or even basic tax software will be able to handle this automatically once the rule is officially in place. You should never have to pay extra just to access a deduction that you're already legally entitled to. Also, be careful about phone calls, emails, or online ads that try to scare you into paying for help. The IRS does not call people demanding immediate action, and they don't require you to work with third-party services to claim benefits like this. The safest approach is always to rely on official IRS resources, trusted tax software, or a reputable tax professional that you already know and trust. Staying informed and being cautious is the best way to make sure this new opportunity actually helps you instead of turning into a headache. Remember, this deduction was created to support seniors, not to become a new way for companies to make money off of them. With that in mind, it's also worth thinking about how this 4-year window fits into your overall retirement planning. Because this benefit is temporary, the decisions you make between now and 2028 could have a meaningful impact on how much you're able to save. For example, if you have flexibility over when you take money out of retirement accounts like IAS or 401ks, you might want to consider how those withdrawals will affect your income in relation to the phase-out limits. The same goes for part-time work, investment income, or any other sources of earnings you have. A little bit of planning could help you stay within the income range that allows you to keep more of this deduction. This doesn't mean you need to completely change your life or make drastic financial moves, but it does mean it's smart to be aware of the opportunity and factor it into your decisions over the next few years. Even small adjustments like delaying a withdrawal or spreading income out more evenly could potentially increase the amount of the deduction you're able to claim. The main point is this: now that you know this rule exists, you have the chance to be proactive instead of reactive. Many seniors will never hear about this until it's too late. By paying attention now, you're already putting yourself in a much better position to benefit from it. And that brings us to the final and most important question of all, which is how you personally plan to make the most of this opportunity before the clock runs out. As we wrap everything up, I want to leave you with a few final thoughts to really put this whole opportunity into perspective. This new senior bonus deduction is one of the most significant tax benefits for retirees that we've seen in years. It has the potential to save thousands of dollars for millions of older Americans, but only if they know about it and take the time to use it correctly. The rules aren't overly complicated. The process for claiming it is straightforward and the payoff can be very real, but none of that matters if seniors simply overlook it or assume it doesn't apply to them. Too often, people hear about a new tax change and think it must be too confusing, too technical, or too good to be true. In this case, it really is a legitimate benefit created specifically to help people just like you. The key is to stay informed, pay attention to the income limits, and make sure you claim it properly during the years it's available. Remember, this is not something you can wait on forever. The window closes after 2028 unless the law gets extended, and there's no guarantee that will happen. That means the choices you make over the next few tax seasons could have a direct impact on how much you're able to save. Whether you prepare your own taxes, use software, or work with a professional, make sure this deduction is on your radar so it doesn't slip through the cracks. At the end of the day, retirement should be about enjoying your life, not worrying unnecessarily about taxes and complicated rules. Benefits like this are meant to give seniors a little extra breathing room and help make hard-earned savings last longer. You've spent decades working, planning, and doing your best to build financial security. Taking advantage of every legal tax break available to you is simply part of protecting what you've worked so hard for. So, as you think ahead to the next few years, keep this deduction in mind. Talk about it with your spouse, your family, or your tax preparer. Look at your income plans and consider how this rule might fit into your bigger financial picture. A little bit of awareness and planning today could translate into meaningful savings tomorrow. And that brings us to the most important question I want you to think about. Knowing now that this opportunity only lasts for a limited time, what steps are you going to take to make sure you benefit from it while you still